Mel, everybody, I'm Cantonese Cat. Hey everybody, Cantonese Cat here. I haven't done one of these reaction videos on my favorite analyst on CNBC, Tom Lee. Let's see what he has to say. And then I'm going to basically chime in from here and there, whenever he's talked about rates and yields and market, things like that. Here it goes.
Is Fundstrat Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right, first, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March. And some people had written cuts off for many, many months.
Yes. Into this CPI print, the whisper number for core CPI was over 0.3. So the market was bracing for a really hot number. And you could see it in the Fed Fund futures where, as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled. And I just think generally, without accounting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay.
I'm going to pause right there. There are a few things I want to respond to. First thing first is that if you are just following the Fed, and this is like the Fed's effective funds rate, right? It's very, very, how do you say that? It's very non-responsive to the economy, to the market. I have to say, whenever yields really have topped in terms of what the actual market conditions are, which is going to be really looking at like the 10-year and the 2-year, yields have topped around October 2023. And when you're looking at yields and you're looking at Fed funds rate, you really are looking at a little bit of a daily indicator if you're just relying on the Fed. And if you are really interested in what the market has to say about what the financial situation is in terms of what the Fed would do, in terms of how it would actually affect the economy, you want to look at real rates rather than the Fed's effective funds rate, because if you do that, then you're really seriously lagging behind. It has done absolutely nothing, around 5.3% for the entire year, all the way up to August 2024. They finally had the first cut around September 2024, right? But if you're looking at the US 10-year, you also look at the 2-year too. The peak was really up here in October 2023, right? Whenever the Fed started cutting around September was actually when the 10-year yield actually started having a leg up, right? So all the entire time when Fed was doing nothing, the 10-year yield dropped from about 5% all the way down to about 3.5%, somewhere around there, when the Fed was just doing nothing, right? The market conditions already sniffed it out. It's basically already easing market condition on its own. And whenever Fed started cutting was when you have this like big giant leg up and everybody got scared about the yields, and how yields going to get to about 5%. But the reality is that if you look at the Bollinger Band here, it's getting up to the top. This whole trend over here with the yields kind of going up for higher and for longer really looks completely exhausted. The 20-month moving average has been upgoing here, but it's really become more and more flat over time. This is a little bit of an exhaustive look. You know how I know? Because as you are trying to make a little bit of a high here, RSI is actually still pointing down, right? The entire rounded top over here was on declining RSI. So you know that the yield trend is going down, and there is not really any guarantee. Matter of fact, I think that it's actually a little bit unlikely for yields to actually break the upper Bollinger Band to make a higher high here compared to October 2023. If you look at the 10-year, it does look a little bit scary, but again, all this happening on bearish divergence. On the 2-year, like, forget about it. On 2-year, you already have the Fed funds rate, coming down, while 2-year kind of bumping up here a little bit, but it's also basically forming a very much of a lower high here, finding resistance here at this horizontal zone. And the entire time, RSI has been going down. It's underneath a flattening 20-month moving average. So the long-term yield is holding great. The short-term yield is not, right? This is actually a pretty healthy yield curve development. And we finally had the, yield curve inversion uninverted, and we're supposed to have a big giant recession with that, but it didn't happen, right? And overall, like, none of that stuff really matters because you also just look at the U.S. money supply. It's just been bumping up and up and up, right? It really bottomed around October 2023. And that's also when a 10-year and a 2-year were at the peak around October 2023, right? It has nothing to do with what the Fed funds rate was, right? Because they really did nothing until September 2024, but the market has already adjusted itself, right? So as far as I'm concerned, I don't really care what the Fed actually does. I care about what the market is anticipating what the Fed would do, and also basically using the real market conditions to try to figure out what the financial easing situation should be, because you already got the 2-year going down and forming a lower high here. You already know that the financial conditions are already easing, right? Because you all just look at 30-year fixed mortgage rate, it still hasn't really formed a higher high here at all. As a matter of fact, it's just been forming a lower high. So as far as I'm concerned, there's not really any particular reason to believe that this whole trend is going to reverse to go up, because you just had a lower low here and you have a lower high here, right? And the RSI continues to go down. So if the mortgage conditions actually still much better compared to where it was before, and the trend is still going down, I'm going to follow what the real rate says, and I don't really care in terms of what the Fed actually does. But the market expectation of the Fed does probably matters more than what the Fed actually does. I guess that's my point. And then the other point that we kind of brought up was inflation. If you look at oil, there's really no reason to believe that oil is just going to keep going up. It does look a little bit like a descending triangle look to it. It does look a little bit of like a dead Cantonese cat bounce to it. And there's no reason to believe it's just going to always like shoot up to the moon. If it does, it could, but it's just been forming lower high after lower high after lower high. And there's a possibility it could fall through the floor here and kind of grab liquidity down here. Oil tends to be pretty well manipulated by the market. So a lot of speculation happened around 2021, 2022, but the speculation is over. And I think right now, for whatever reason, the oil price just hasn't really been all that hot, if you will. So I don't really see any particular reason in terms of why inflation would go up. I also mentioned why inflation went up in the first place in 2020, 2021, 2022 was because of three things. First thing is that the Trump tariffs was still in place. The Biden administration did nothing about it. I do worry about the Trump administration could potentially bring more tariffs, which can bring more inflationary pressures to the economy, which I don't know if I would agree with that policy, but I'm just a cat, who knows. The second thing is supply chain disruption from COVID. That's done. Like, you already had AI development, you already have all kinds of things that are in place to prevent that from happening, and we're not having a once in 100-year pandemic going on anymore. So I don't really see that being a particular factor. And the third factor in terms of inflation is really the money printing. As far as I'm concerned, this is the amount of money printing, and I should really do it on log scale, because they really print money on log scale, right? What has been happening? Well, they've been printing money like crazy for ages, as far as we have the AM2 money supply being shown here. And what you can really see here was that we are just returning back to the usual money printing rate, right? We went way too far, way too fast in 2020, and we had to have quantitative tightening. And right now we're just putting money back into the usual rate. There's nothing unusual about the amount of money that we've been printing compared to over the last several decades. So as far as I'm concerned, I think we are still at the right trajectory for the market to continue to recover. And there's not really any particular reason to be worried about things. Let's go back to Tom Lee and let him finish, and we'll kind of take it from there.
How optimistic are you for the type of return we could do this year after back-to-back, 20 20+% gains for the S&P.
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions, and I think it's.
I'm going to finish a couple points here. Tony mentioned there's a potential 80% chance where we're going to get greater than 20% return on the S&P 500. I agree with that. I mean, I just look at the overall economic trend here. I have this Gantt square here, which is based on the bottom of the financial crisis, and we've had these circles which are Fibonacci based. And also these horizontal lines here are also Fibonacci based. They really have tested all of these lines and curves exactly where they're supposed to be. The next curve is called right up here. I think that in 2025 is probably going to be a good year, maybe even extend to 2026. Who knows? But I just think that currently the trajectory, because we've already gone through a lot of these kind of resistance and support levels, I do think that most likely we're going to end up going up a lot higher. A lot of people forget that we've had a big giant downtrend here, and really throughout 2023 was really just trying to make back to the previous high here. So even we had greater than like 20% gain, it was just basically just a wash compared to the big giant downturn in 2022. And 2024 has been extremely a good year, but I think that it doesn't necessarily mean that we're not going to have another good year just because we had 2 great years so far because of how brutal 2022 was. You look at the NASDAQ, I have to remind you, NASDAQ dropped down 40%. And just because you have greater than two years or greater than 20% doesn't necessarily mean that it's gonna, not be a good year. And I also have like great market symmetry here to look at the Gantt chart here. Basically, it's just been following arc level after arc level. We really had a lot of major correction over here, and we spent about 2 years around here, right? So now that we've gone through it, back test to arc as support after finding some resistance here, after finding support here at the bottom of the arc, I think it might be ready to gravitate up here towards the next arc up here over the next year or two. So I do think that 2025 most likely is going to be a pretty decent year. I don't really see things being overextended here on the Bollinger Bands, on the NASDAQ, QQQ, nor am I seeing that really here on the S&P 500. So anybody who's really calling a top, I think they're just kind of guessing. And I don't really have any major concerns over what the economy is doing, inflation, all that. I do agree if bond yields end up staying above 5%, which is currently not doing right now, right? I mean, bond is still less than 5%. If anything, I think that is looking a little bit exhausted, just like how I was showing you in terms of the trend. I don't think that it has to, be a headwind anymore, especially when it comes to like the short duration yields, like long duration yields maybe, but short duration yields, I think it's done. Even for 10-year, this is a pretty bearish candle for the 10-year. Looks a little bit like what do you call like a gravestone doji kind of look to it. These are generally bearish. You also look at a weekly so far. I mean, the week's not over yet. It's only like Thursday, but you have a little bit of a bearish engulfing candle over here. So it looks a little bit toppy here, I guess is my point. So I just don't know whether or not bond yields are going to be a headwind moving forward. But if it goes up, sure, there's going to be some headwind. But the trend's your friend. I think that the trend for the yields are exhausted. I like the trend of the market. So here it goes.
It's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way of saying stocks will not be good if bond yields stay where they are now.
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow, so if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns there's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
Isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade. Based
I don't really care about growth leading to inflation. We've had growth for how long now? We've had money printing for how long now? We've had growth in the S&P 500. If you look at the monthly chart here, we've had growth in the S&P 500 for a very, very long time. I had to do this on a log scale just to try to make sense, right? Over the last decades, I can even look at the SPX here. Over decades, you have growth, but most of the time, inflation is still closer to 2%, and they actually have to print money to make sure that the deflationary forces like innovation, like computers, cell phones, things like that, are not causing deflation. So that part I don't really care about. The only thing I really care about is whether or not the Trump administration raises tariffs. I think that could be kind of terrifying.
on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation's getting strong.
Okay.
I completely agree with him. I'm just gonna, I love Tom Lee. I'm done. You guys take care. Have a good one. Bye.